Hello and welcome to this video on market performance ratios. The stock market is a fantastic source of information about companies. Investors, through their buying and selling decisions on the stock market, give away a lot of inside information about the likely success and future performance of companies. Therefore, using information from the stock market and combining it with financial statement information allows us to calculate some ratios that tell us a lot about the firm's performance. The earnings per share ratio is calculated as the total net profit divided by the average number of shares for the firm, and it tells us what return each share owned by a shareholder has actually generated. Now, the earnings per share can't be compared between different companies because the number of shares is different, but comparing for a single firm over time, it tells us about the earnings backing behind each share you own in the firm. We can use the earnings per share calculation to then calculate another ratio called the price to earnings ratio. The price to earnings ratio is calculated as the stock price per share divided by the earnings per share, that EPS figure we just looked at. The price to earnings ratio is a fantastic ratio. It compares the actual stock market price of the company compared to their current earnings, and it gives you an indication of what investors believe the future growth of the company is going to be. It also gives us an indication of how valuable or the price we're paying for the shares. A price to earnings ratio of 20 indicates that it will take 20 years of current earnings just to pay back your investment in a company. And at the moment, price to earnings ratios are at historic highs, and a price to earnings ratio of 20 is a pretty common PE ratio for many firms on the stock market. Another powerful ratio is the market to book ratio. The market to book ratio takes the market value of a company, that is the stock price per share times the number of shares. That's called the market value or market capitalization, and we divide by the total owner's equity on the balance sheet. So this is comparing how much the stock market think a company is worth compared to how much it's worth in the financial statements. And we'll find that they're often very different numbers because of the different accounting rules, meaning the balance sheet has to use historical cost accounting and be quite conservative. So when we have a high market to book ratio, that is the investors on the stock market think the value of a company is much higher than the balance sheet indicates, that's a great sign for potential future growth of the company. It means investors believe the company's value is much higher than the assets on the balance sheet show. It's a sign that investors believe the company is going to use those assets to generate abnormally high profits into the future. On the other side, when the market to book ratio is very low, it indicates that investors don't believe that the balance sheet's actually telling us the truth about the value of the assets, or that management do have valuable assets, but they're going to utilize them so poorly, they're going to destroy value. So the market to book ratio gives us a fantastic insight into what investors believe managers are going to be using their assets for. This is just a small subset of financial ratios that we can look at. The price to earnings ratio and the market to book ratio are fantastic ones for giving us an insight into what investors believe is likely to happen into the future, and they get used a lot in valuation work. When people are investing and buying and selling, they'll often utilize the market to book or price to earnings ratio as justification for their decision making. Thank you.